Hey guys, my name is Minh Vo. It is a huge honor for me to have uh, John Osborn here with me. John and I've worked together for quite a while. John is a certified financial planner, certified fund specialist, board certified in securities, and accredited investment fiduciary. He's got a PhD in behavioral finance. So I figured who would be better than to interview for our first podcast. John, tell me a little bit about yourself. How'd you get started? How long have you been in the business?
Well, I've been in the business since they invented dirt. Uh, no, actually, this year will be my 45th year. Started with Merrill Lynch a long time ago in Detroit, and moved to Houston in '79. And for I became a kind of like a what they call an equity specialist and running for many insurance companies. At one point, I had over 106 registered reps working for me, and went independent a few years ago, and like you did.
Yep, yep.
and and now we have our own little group here in Houston.
Okay.
So I have two companies. One's called Houston Capital Partners, and the other one's called the Pension Professionals.
Okay, awesome. Let's dive right into it. Obviously everybody's top of mind with where the market's at. With the Nasdaq being down, I think almost 20+%. The S&P kind of teeter-tottering on that bear market kind of number. So let's talk about just kind of the market itself. They're raising interest rates, and what does that really affect things and real rate of return, that kind of stuff?
Well, that's an open topic. Let's see if we can cover it without going into under the bushes too much here. So you have an inflation that is been brought up by a number of reasons. We had the lockdown, and we had supply chain problems, and so forth. And this is not my first recession, and so what the Federal Reserve is doing is trying to prevent it from getting a deep, solid hold into the economy. Because once you get inflation deep into the market, it's really hard to get rid of. And I think we're starting that already. I don't think it really got deep into the market yet. So we're seeing a lot of commodity prices already start to fall, but we have to worry about wages. That's kind of sticky, and rents kind of sticky. But you got to remember on the rent side that the government did a restriction. They couldn't raise rates during the pandemic, and so now a lot of the business owners are starting to raise their rates again, and that has to wash its way through the market too. So we're starting to raise interest rates to start to slow down the economy, start down the whole process, and it's beginning to take hold. In the meantime, if you're a business, it could be dangerous for you because your cost of capital. If you were building something and you were borrowing money at 2%, now you're borrowing at 5%, may slow down a few things, which is the intent of the Federal Reserve. Federal Reserve's intent is to go in and make your life hard so people don't buy as much stuff and prices don't go up so much, and people don't keep asking for raises and so forth. So hope that's not too much in a nutshell.
No, that's good. So I think you and I talked the other day on the phone about the real rate of return, right? So how is this kind of low inflation, low interest rate environment we've been in the last almost decade and a half affected things in terms of the real rate of return, and where do you see us going with that?
Well, first of all, for the definition, you have a rate of return. So let's say you're making 4% on a CD or something. And historically, if you made 4%, you had a 2% rate of inflation. So at the end of the year, you really only made 2% because 2% was eaten up by inflation. What we have right now is we have got let's just use it with the benchmark 10-year bond, and we could use a lot of different things. We'll just say the 10-year bond. So that's yielding about 3% right now. And if you've got inflation at 8%, you're at -5. 8 from 3. So what the Federal Reserve is trying to do is get the interest rates up a little bit and keep the inflation back down, and that's a pretty good challenge right now. So if we can get it down to par, let's say a 3% bond rate and a 3% rate of inflation, I think the Fed might consider that a victory. In the long run, 23, 24, they're shooting for 2%. So, and I think it's going to happen. So, but in the meantime, that's going to cause a lot of pain on Wall Street, and that's what people are talking about, the famous recession, if we're going to have one or not. And that's kind of depends on your definition of recession, but generally accepted it's 2 negative quarters of GDP growth. And remember, we just had one. We won't have one this quarter. We're not going to have a recession right now.
Okay.
Could happen.
So let's just say, what's stopping it from saying it's already been called, right? So a lot of times we get recessions, and by the time they call it, it's kind of over, right?
Yes.
In terms of the '08 recession, when we had it, I remember they called it in late December. I was a kid working with you actually in 2008. They called it by right around late December. That was when pretty much it bottomed out and we were kind of on the upswing, right?
Exactly.
And most recently, they called the recession in June of 2020, right after COVID, right?
Right.
And obviously, as soon as they had called it, it was already back on the upswing. So I think the interesting thought or question is, have we already had the recession? Is it done and over with?
Well, yeah, that's a good question, which we don't have an answer for. But we'll talk historically. Usually, the stock market goes down in a precursor, thinking they're going to have a recession. Paul Samuelson, the famous economist, once said the stock market has predicted 9 of the last 5 recessions. So a lot of times, stock market will go down thinking, "Oh, we're going to have a recession," and then we don't, and then the market comes back up. And people have to understand is probably by the time there actually is a recession, from an investment point of view, you've probably already missed the boat. And I actually, personally, my opinion is that we've overplayed this on the downside already. The stock market going down 20% when you don't even know if you're going to have a recession or not. And it's probably the generally consensus opinion is if we do have one, it'll probably be mild. There's a certain part of me that says, let's have a recession right away, get it over with. It's like, does everybody feel better now? Okay, we had a recession, now we can go on and do our business. And but we got to wait for the CPI to start coming back down before the Fed will quit raising interest rates, which is a whole other topic.
Okay, well, that's probably the next topic. So you got some news today. You said there's some inflation numbers that the government had kind of looked at are kind of on the downtrend. What's that all about today?
Well, you got to remember that when the government reports numbers, they're reporting what has already happened. And and if you ever remember that, like gasoline prices, which is a great thing to talk about. Gas is probably your perfect example right here. In the first part of the month of June, the gasoline prices were going up, stock market was going down, and the glass, from Wall Street's point of view, the glass was half empty. Geez, this is terrible. We don't know when it's going to end. But toward what's happening now, and we're right at the end of June, is gasoline prices. And there's places to follow this if you know what you're looking for. Have dropped dramatically. In the wholesale price of gasoline right now is if you took, and this is how you price it at the pump. So everybody knows, they look at the pump and they go, hey, gee, prices are going up because gasoline's going up. It's gasoline's or diesel or oil or whatever. It's pretty much used in any type of business that you're going to do. And that's what most people see for inflation. I mean, I couldn't tell you what a dozen eggs cost, or if a head of lettuce went up. I wouldn't know. I don't think most people do. But they see it at the pump. Now, I'm going to tell you that based on today's prices, the price of gasoline should be selling in the next couple weeks here in Texas at around $4 a gallon, maybe less. That's what's happening now. So the $5 gasoline has gone to $4 gasoline. That's not inflationary. And if you take a look at what it's going to be around Thanksgiving or Christmas, gasoline should be all things being equal, around $3.40 a gallon. So prices are coming down. The same thing's happening with lumber. Lumber prices have fallen close to 50% from their high. Copper, which is we call the metal with a PhD in economics because it's a great predictor. Yeah, that is down about 10% year to date now. So you see the same thing happen in cotton and a few other things. So commodity prices, things that we build stuff with and so forth, those are coming down quite a bit. But you have to understand that a significant portion of the CPI index is rents and wages. So, point being is that we think the CPI is already peaked. It's going to start coming down. We have a CPI coming out. I think it's July 8th, but that's going to reflect June. And as I just said, a lot of the high prices in there were already in the first half of June. So we think the CPI will come down a little bit in the July, not a lot. Now, the Fed will then probably raise interest rates like they said they were going to, and probably 0.75 in July. Then it gets interesting because the Fed doesn't meet in August. So by the time the Fed meets the next time, you'll have a CPI index that came out for August and September, which we think are going to show that it's rolled over and it's heading down. We might see 6 and 5 on our next two CPI indexes. And then what does the Fed do in September? And then it's going to get really interesting, and that's where I think the market's going to turn around, come back.
Okay.
Long answer.
No, that's a good answer. So I think the other thought we always have is interest rate hikes, right? So we had the most recent one where the Fed surprised us a little bit by, instead of 50 basis points like their guidance, they went to 75 basis points. Somehow that really didn't hurt the market. The market looked at that and said, "Oh, it's it turned positive." Your thoughts on that? How did it work? Why did it work?
Well, people have to understand that these interest rate rises are already in the market, and they're already priced in. So for all the interest rate rises this year and next, so if we don't have a rise in interest rates, we could actually see the 10-year bonds start to come down. Just for your reference, the 10-year bond has actually come down in the last 2 weeks with the anticipation that maybe this scenario that we're talking about is beginning to play out. So it's getting interesting. It's getting interesting.
Okay. All right. So we all kind of feel the pain at the pump, right? And we talked about this, the whole Russia situation, right?
Yeah.
How's that going to play out in the next, 5 years, couple years, whatever the situation is? And it's kind of interesting, right? You look at, we were in the Iraqi war for almost 20 years, and it really didn't do much for the market. So how much of this is hype with the media? And not in terms of, obviously, Ukraine being attacked. That's a terrible situation, just in terms of the market itself.
Well, of course, I think that's all in the market too, and maybe they've overplayed that. You hear some people want to talk about the gasoline sanctions, and yeah, that's hurt a lot. The oil sanctions for Central Europe, but it's pretty much in the market. I mean, they pretty much played this out the worst possible case. And again, I think we could have a positive surprise if something happens positively in Ukraine. Although they look pretty stuck in that right now. It's real expensive. People don't understand that it's real expensive for Russia to maintain this war that's going on. And a significant portion of their military lost. But again, that's not the topic for today. But I think it's already fully in the market, and all the negatives have been played out. I mean, something else bad can happen. They could start going to tactical nuclear weapons or something and have a surprise. But right now, I don't think that's going to be a big factor at all in the United States markets.
Okay. All right. So we've got obviously probably three types of people listening. There's one person on the listening right now going, I've got my money in the market, I'm retired, or I'm just an adult in general, and I am just ready to sell out, put everything in gold, stuff it under my mattress, and wait for it to be over. What are your thoughts on that, John?
Yeah. Well,
we have those mattress people.
Yeah. Well, it's kind of interesting. That's a very good point, is that if we're going to have inflation, historically, if you're going to have inflation, people put money in cash and they put money in gold. Okay. Why isn't gold going up? Gold's about what we're talking about right now is about 1,820, and a couple months ago it was right there around 2,000. And you had a lot of those gold bugs and pundits of inflation, and you see some of those advertisements on TV, and it's gold's going to go, and this is what happens, and the money supply and all that, which is a whole other topic that's come down dramatically. So the gold's not going up, so it's telling you that maybe we're not going to have an inflation. So that's one thing to talk about, and two is the money supply. The M2 has been coming down dramatically. Remember last year it grew by, or there was like an 18-month time period that it grew by about 25%. So what you have is a lot more money in the system trying to buy less goods. Your Econ 101 definition tells you that's inflationary. If you got a lot of money out there and not a lot of stuff to buy, people will bid it up in price. The money supply has been coming down quite a bit. And then the Fed is also buying back or reducing their balance sheet, which is, again, taking money out of the system. And yeah, this is going to catch a lot of people by surprise. The money has been drying up from the Federal Reserve, and you don't have a lot of dollars chasing too few goods right now. It's starting to tighten. People are maybe putting that money in savings and so forth, and they're not incurring more debt. So I think the inflationary thing is starting to die down, and the money supply is coming back into control. The money supply is going to take a couple of years to actually completely wash out to the system, but it's we're going at about a 3.5% range, which is normal. So we're all past the post-pandemic type thing.
Okay, then we get the second set of people that are going, I've been sitting on the sideline probably since early 2020 or late 19. I missed the boat in terms of that kind of meteoric rise from 2020 to 21, the end of 21. But man, am I glad that I stayed out, because it went down and then it went up and then it's kind of down again. So I think I'm just going to hang tight here until this all kind of boils over. The money supply gets out of the system. I'm just going to hang tight in cash, buy some CDs maybe. Those are starting to look attractive.
Yeah, and you hear that sometimes from people who are maybe younger, or middle-aged people who are saving in their qualified plan. They're just saying, well, I don't know. I don't know what's going to happen. Everything's so bad. Maybe I should get out and just, put the money in the mattress again, like we were talking about. But let me give you a great example, especially in 2008. So when the market crashed in 2008, the Dow Jones fell down, I'll use the S&P. That's a great number. The S&P was around 1,400, and then it fell down, and it went all the way to, I don't know if anybody knows this, but it went all the way down to 666. And then it turned around and came back, and it took it about 18 months to go from where it was to get back to where it was. And a lot of people say, oh, gee, I'm back to break even. But those people who are in 401ks, they were buying it as it goes down, goes down, goes down, goes down. At the bottom, they're buying it, going back up, going back up, going back up. So by definition, all those buys that happened over 18 months made money. If you were buying at the bottom when it was down 40%, those purchases alone are up 40%. But then you had the other people that they went down and they go, I give up. You know, they're not, and they didn't buy it on the way back up.
Right.
And so forth. By the way, that 666 number, when the S&P just bottomed a couple weeks ago, it hit 3,666. By the way, kind of strange. We can talk about that in another broadcast. But that kind of interesting little tidbit there.
So, and then I think our third camp of folks are going just kind of analysis by paralysis.
Yeah.
You know, I'm not sure where to go. So where do I go? What do I do now?
Well, there are a number of, I mean, you can look at, and I wish we had it here to show you, you can look at these 50-year, 100-year charts of the New York Stock Exchange. And, you know, it goes from the lower left-hand corner to the upper right-hand corner. And along the way, you have the great, you know, 29s and then the 40s and, 74 and the sideways on the 80s and so forth. And I tell my clients, I see how it goes down like that and goes up, but it keeps going up. I said, you know what you call those dips? Buying opportunities. And this is another one. If you think this market's going down and staying down, it always could, hasn't happened yet. So, and I think they've really overplayed this one. Yeah. And an interesting point of view is that when people are the most bearish, or you have the smallest percentage of people that are out there thinking the market's going to be going up, that's always the best time to buy. And conversely, it's always the best time to sell. When everybody is bullish, and you know, they people in surveys that call you, are you bullish or bearish? And people say, well, I'm bullish, you know, I'm buying in this market. When people are bullish, it means they've already bought. So they put their money to work, and only one of two things can happen. Either they do nothing, or they sell. Same thing right now. I don't know anybody who is going to sell that hasn't sold already.
Right.
You know, the saying, if they can't scare you down, they wear you down. And I think right now there is a American Association of Independent Investors. I hope I'm not boring anybody here too bad. But they're right now, we've had 3 of the last 6 weeks where the market was actually below 20%. The bullish indicator is below 20%. Historically, 31 out of 31 times when that has happened, the market is higher at the end of the next year. So we know this is 100% correct. Historically, is this time going to be different?
Potentially.
Could. You know, this could be that, you know, that one goofy time, but it kind of makes sense, you know, unless something crazy comes out of left field that we haven't seen before, which could happen. I just think it's one of my favorite indicators. When I see that happen, I always know it's either if it's the bullish is too high or the bullish is too low, you should be taking action at that particular point. And if you think this one's going to be bearish forever and ever and ever and ever, and the market's never going to go back up,
I don't think that's happened in almost 150 years in the market, 150 plus years that the market's been around, right?
Yeah, I was just a kid when it started.
So. I think the other thought behind this is, you know, why is it that individual investors generally have a lower rate of return than the market itself, right?
Yeah.
There's a kind of a behavioral finance piece to it, which obviously you have a PhD in. So the question is always, why do individual investors always end up with a lower rate of return in the
Yeah.
market?
It's kind of crazy because over the long term, the average investor doesn't do much better than money markets. And it's it's just the fear and greed thing. Market equities, stocks are the only commodity that people don't like to buy when they're on sale. If you're going to buy a refrigerator and it drops $200, you might want to go out and buy that refrigerator or that big screen TV.
Or a couple of them. And
Yeah.
sell them off to your friends. Whatever.
Yeah. But equities, it's like, no, I'll buy it when it gets higher. When it comes back, I'll buy it. So unfortunately, there are a lot of people don't understand, what is high and what is low. And it can be confusing. But you could have been buying Tesla at 1,200 several months ago, and now you can buy it for under $700. Is it a thing to buy? I don't know, but they seem to be doing okay. Same thing with Apple and Microsoft and good Procter and Gamble. Good companies out there that So we look for the best managers and we look for the best equities, and you can just look at some of these and going like, well, this is going to be higher in 12 months.
Yep. All right. So here's the fun question, the chasing heat question. Are those folks that, again, another camp of folks are the ones that are chasing the heat, right? The oil and gas heat right now, the Exxon Mobils, the CenterPoints, the Chevrons of the world right now. They're going. Those are up 60% this year, 50% this year. I should go buy those.
Yeah. I mean, it's kind of hard to find somebody who's had Exxon for a long time period who's actually lost money. And I'm not calling a top here on energy by any stretch, because energy prices probably will continue to be up for a while, and these guys own a lot of assets in the ground that they bought at a lot lower price. So they've got a nice cash flow coming up. But I think you've seen a significant portion of the run up for the oil and gas companies, a significant amount. And you still have that overhanging thing that eventually a lot of people want to make the renewables the main source of energy. I don't know if that'll happen in my lifetime, but if you want to build a refinery, nuclear power is a great example. It's just the government just makes it almost impossible to do. So, and the good side is that the government cut back on a lot of drilling, which made it real profitable if you're in oil and gas business, because most likely these guys have already got the assets in the ground and they're not making any more of them. So, but they are making more of them. Being facetious, rig counts up in West Texas are much, much higher than they were. I mean, it's almost doubled in the last, 9 months. Okay. So it's interesting. So I think maybe energy's probably had 70 to 80% of their play that you're going to see over the next 12 months.
Okay. So I think the chasing heat thing is I always find that an interesting kind of call that I get. Hey, let's go buy this. Well, I think we're already there. We've already passed that peak. I think the second one is obviously time in the market is more important than timing the market, right?
Exactly.
Based on what you said earlier. And I think probably the last and the most important is, as you look at the market, right? What do you see out there? And I don't think anybody can ever really see what's going on, right? If we were, we would be sitting next to probably Elon or Warren or whatever it is. But, I think the last and the most important one is, when others are, fearful, be greedy, right?
Right.
As Warren Buffett always says. And, when others are greedy, be fearful, right?
Yeah. I think Warren said it best when he said, when there's wailing and gnashing of teeth in the streets, it's time to buy. So, and you're pretty much there right now. I mean, when you're down 20%.
And I mean, we got there probably, most of the 20%, we got that in the first 2 months of the year, really.
Yeah. So
we've just been hanging on for the last 3-4 months.
A lot of things that people aren't fully appreciating is that corporate earnings are actually going to be up this year. When you tell that to people, they go like, what? How can that be? Corporate earnings, and we pretty much know what they're going to be the rest of the year and what they've done in the first half, are probably going to be up 8 to 10% this year. And they're probably going to be up 8 to 10% next year. So why is the market down 20%? The valuations have gotten to the point, and I look at this very, very closely. I think the valuations are pretty much on the oversold area. And I can make a wonderful case that the medium-sized and the small-sized stocks are just selling at, use your own terminology, but they're on sale. They're on big-time sale. And these are some of the best places to be in the long term. But you have price earnings ratios that have fallen over 50%. So you've got a lot of good companies on there that are selling for half price, and they're not going anywhere. So, it's maybe that, maybe it is that time to start scooping up some of the smaller things. That's a smart people like men to do. But yeah, I think so. I think we've overplayed that hand.
Okay. All right. Interesting. So, I think the last question for every investor is, we've already answered kind of this hop in or stay out, but I think the last question is, do we see interest rates continuing to soar to the place where they go, beyond and push us into a really bad recession, right?
Yes.
You see the
Don't
Fed
think
doing
that's
that.
going to happen.
Yeah.
Personally, I think you get the Fed may only raise rates in September 25 basis points, and they may even pause at that point. So this idea that interest rates are going to go up indefinitely and the market is going to go in the tank, in reality, that's not going to happen. I think the Fed is very conscious. They're going to look for this, what they call a soft landing, where they can bring this beast down and not crash, but kind of glide and then eventually take back off again. Prices are going down. Federal Reserve won't have to raise rates as much as everybody thinks they're going to do. Corporate profits are still going up. So you just keep a close eye on that, but we don't think that's I'm still looking for the market to be up this year. Personal opinion, but if you have the 10-year bond staying at 3%, and boy, I'll bore some people with this, but the capital asset pricing model, which has been historically very, very correct, is that at the current valuations and where it is right now, the market should be up for the year. And you can't get away from profits. That the market always comes back to valuations and profits. If it stays at 3%, we're at a good place right now. If it goes up to 3.5 or 4, all bets are off. Then maybe we are fully valued at where we're at right now. So at this time, in this place, at this date, right now, we're looking at the CPI numbers coming down the road. So we're just kind of hoping the calendar moves pretty fast here. Maybe go out and take a 2-month vacation and come back and look at it then. But we think the worst is behind us. Now we have to play the hand out. We did all the selling and discounting. Now we're going to probably go sideways. We'll do some of this choppy thing. And then eventually I think we'll start working our way back up when people realize that things aren't as bad as they think they are.
Okay, well, that's good. Yeah, I think it's an interesting conversation. People always ask, are we going to go straight into this kind of dirt recession, and really go down into the tubes? I don't think that's going to happen either. So I think that's pretty much the end of our time here. We're running right on time, on schedule. So thanks to, as we joke, Dr. Osborn is in the office with us today, or I'm in his office actually. And we'll catch you guys next time. Thanks.
Thank you.